Hello everybody, so this video is entitled MSTR Stock, My Takes for Q2 MSTR Reports Tonight. Now we know that for MSTR, usually earnings do not move the stock that much because MSTR of course reports any material information every week, so the earnings really don't move the stock too much historically. I don't expect that much of a move. But I'm going to tell you kind of a state of strategy, kind of what I think is going on in 5 points. I have 5 major points, 5 major takes prior to Q2. So, and the reason, of course, why I can't cover Q2 is because I'm on a flight again. So anyways, I won't be listening to it live. I'll probably get to the call later than most watching this video. So let's talk about things that I don't like, first of all. Strategy hasn't bought Bitcoin in 4 weeks, going in on 5 weeks. That's nearly a month, right? We're at just about a month of no Bitcoin buys. I obviously don't like that. But why do we not buy Bitcoin? Because Stretch is not trading at 100 anymore, and the sole goal of strategy, the sole objective is for Stretch to get back to 100. So Saylor has been going all in on digital credit. Whenever he sells the common stock now, it is to help Stretch. And how do you help Stretch? You help Stretch by improving the cash reserves, by increasing the USD reserves. And strategy has done that, of course, 3 days ago, increased the strategy, the USD reserve by $500 million. And my guess is that he's going to continue to do that to help Stretch get back to 100. He's been stacking cash. He's been sacrificing the common stock to do it, using the common ATM to stack cash, because Saylor views Stretch as the long-term solution to buy Bitcoin. Stretch is the only instrument that Saylor wants to sell to buy Bitcoin, because if you sell Stretch at 100 and if Stretch trades at 100, theoretically 5 years from now, 10 years from now, Stretch will pay a lower yield because the yield will be lowered because the interest rates will come back down. Unfortunately, the interest rates are not headed that way right now. The interest rate environment has been doing horrible, right? Bonds have been doing absolutely horrible. So, of course, a credit instrument like Stretch is not going to do well in an environment where the bonds have been doing so poorly. But Saylor is focusing his laser eye on Stretch. He's all about Stretch, and that's why he hasn't bought Bitcoin, because he's moved on to a digital credit company. And so one of the questions, I guess, to ask moving forward with strategy is, what is your belief in digital credit? How much do you believe in digital credit? I still think Stretch is an amazing instrument, but we need to get back to 100. We need to get back to 100. Saylor realizes that, and that's why the whole company is focused on that. The reason why Stretch was created is because Saylor realized that most people had a hard time understanding Bitcoin, but most people had a much easier time understanding Stretch. 11% tax deferred. That's much easier to understand for most people than buying Bitcoin is easy to understand for most people. And as he said in multiple interviews, he's tried to convince people on Bitcoin for half a decade now, and it's still very tough. Stretch can be explained in a short elevator pitch. In a matter of 20 seconds you can explain Stretch. So that's the whole strategy behind the move towards digital credit. Hopefully he gets it back to 100, but he needs help from the market. He needs help from Bitcoin going back up. He needs help from bonds going back up. He needs help from yields going back down. We're not getting that help from the Fed, as we saw yesterday, and the dissenters, free dissenters, advocating for a rate hike. We're not getting that help. So right now, of course, strategy is going through its own valley of despair. Another solution, of course, to get Stretch back to 100 is the buyback. Now, he did $25 million in buyback last week. I consider this to be mostly signaling. That's not significant. I don't think 25 million is going to move the Stretch price, but we'll see if he does something meaningful, or if he signals whether he wants to do something meaningful. Of course, the ongoing authorization for the Stretch buyback is in place, and it signals that he wants to do more, right? Because there's 975 million left for that buyback authorization. So he may do more, and we'll see if he does like a $200 million buyback, like, you know, 250 million, something 10 times bigger. We'll see if that actually moves Stretch or not. But that seems to be another solution for him to get Stretch back to 100 is the buyback. So we have the buybacks to get Stretch back to 100. We have the increase of the cash reserve, right? 3.75 billion, increasing it again, 2.1 years worth of dividend coverage, wanting more dividend coverage. So that's another solution that he's looking at to increase Stretch. But of course, one of the big aspects that will help Stretch get back to 100 is the yields going down. Now, unfortunately, perpetual debt, right? Perpetual debt is longer than for 30 years. So what's the right yield to compare it to? Well, first of all, the 10-year yield, Treasury yield, is at an awful nearly 4.7%, and it's been stuck up there for a while, and that's really awful for mortgages. That's awful for all sorts of debt. That's bad for the government. But if you look at very long-term debt, it's even worse. We are. I think it's the highest. Is it in 21 years? Or if a 30-year hasn't been this high in a very, 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 very long time. We've broke some recent record here at 5.2. So, and that increase, of course, in the 30-year has been pretty recent. You can look 2025 has been up only in 2025. My chart's a little small, but if you look at it, it's been up only. So the fact that 30 years is 5.2%, that's not helping a credit instrument like Stretch, because whether we want it or not, Stretch is competing with 30-year debt, and 30-year debt is now paying 5.2%, right? So Stretch needs to pay more. So that's for Stretch. That's enough for Stretch. Let's talk about the strategy. I think the strategy that Saylor should do, and I think the strategy that Saylor is doing in many ways, is the wait strategy, and in many ways that is what Saylor is doing right now. Why? Because we've had no new Bitcoin buys. We've had dilution, but the dilution in the grand scheme of things has been relatively small. I mean, over the long run it adds up. Don't get me wrong, but it's been relatively small. We haven't had this crazy dilution for like a $2 billion buy. Like, we haven't had that in a very long time. But we've had few hundreds of millions of dilution here and there, a week here, a week there. So it adds up over time, right? Over 2 months, that becomes meaningful. But it's been about a month worth of I would argue fairly small dilution. That may be Saylor's version of doing nothing and waiting, because the thing that will get us out of this route, and it's all linked, by the way, is, you know, interest rates coming down. If interest rates come down, risk assets go back up, and Bitcoin, of course, is the apex risk asset, at least as Wall Street still sees it. And so if yields go down, if rates go down, then, you know, in theory, risk assets should go back up, including Bitcoin. And if Bitcoin goes back up, of course, the collateral for Stretch goes back up even further, and that will help Stretch. So that's why, in my view, waiting is the only way. I know the market has been in this valley of despair since October 2025. We've had nothing but down since October 2025. How many assets have had 8 months, 7 months, back to back down for like 7 or 8 months? How many assets have done that? So many. The market, in many ways, has been in a bear market, right? We see this morning the Nasdaq now in correction territory. So that hasn't helped, but that's outside factors. That's macro factors, which is why I think the best strategy for Saylor is to just wait, do nothing and wait. And of course, that's what I think he's been mostly doing, with a little dilution. So if you look at 1 month, the price of strategy over 1 month, actually, if you look at pre-market action, it's exactly the same. We have had the price action of strategy over 1 month has been exactly the same as the price action of IBIT, the Bitcoin ETF. I use IBIT because it's the same market hours, right? Historically, strategy is supposed to be 1.5 times, right? So we haven't had that. Strategy hasn't outperformed Bitcoin by 50%. Why hasn't that been the case? Because of a common ATM. Because we've added so much cash to the cash reserve. That's what I think it hasn't been the case, because he's been ATMing a little bit, not too much, but a little bit. So right now we're at a correlation of 1. Obviously, if Bitcoin goes back up in a major way. Strategy will go back up in a major way. These two are very much correlated. And stretch will go back up as well if Bitcoin goes back up. It's all about Bitcoin. This stock has always been about Bitcoin. But strategy is stuck. There's not much they can do at a 1.03. All they can do is wait. Right, and that's why, you know, taking the summer off is probably not the worst idea for most people right now, because these markets probably don't deserve much of our respect at this point. Bitcoin is at 64,700. It's been trading in a range for, like, you know, nearly a month. And fear and greed, we're still in fear, but barely in fear. We're gonna get into neutral slowly. I think we're gonna get into neutral. But, you know, the real solution for strategy to recover and get back up is for Bitcoin to recover and for yields to come down, for the Fed to actually not give us a rate hike in September, for inflation to come down. And of course, inflation will come down based on the Middle East. But the Middle East the situation is not improving over there. So oil is still through the roof. And if oil is through the roof, CPI is going to be through the roof, inflation is going to be through the roof, and the Fed is going to want to raise rates. It all starts with that, folks. It all starts there. So it's all about the macro. The macro has hurt many assets. It really has. So anyways, that's the way it is. These are my Q2 takes. I hope it doesn't announce anything too big on the call. Just wait. I think that's what we all have to do. Just wait for the market to get better. And I know it's been annoying because we've been waiting for so long to get out of that Fed macro madness that got initiated in 2021, 2022. We've been waiting for so long, but, you know, we still have to wait, unfortunately. So this was not investment advice. This is not financial advice. This is only entertainment. I'm hoping you're entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful day.